Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. And here we are. It be Friday today there, laddie.
And a bit of a comeback in the markets after another rough week. What are the markets telling us with the pattern that they're setting up?
Oh, yeah. It's not just a bear market, Jim. And we don't use the definition that if a senior index or a stock is down 20%, then it becomes a bear market. No. You want to make the call at the top, which we did, and the probability has been that since we were in a great financial bubble, and when they blow out, they're followed by severe contractions. And this hit to the stock markets is getting to be rather severe. And what I was thinking about when we were writing yesterday, on Wednesday, that what's missing? We've had the weakening industrial commodity prices on schedule. That was good. You had a turn in the credit markets where the yield curve reversed from flattening to steepening. That was in late summer. And then it wasn't until early October when you had a distinctive change in credit spreads to widening as crude oil came down. And then came the liquidity problem, which was likely to be discovered in the fall. And on our work, the latest of that the distress could run would be into Christmas, which it has, and then you've had a couple of volatile days in here, which, Jim, I would take as trying to find a bottom. There's been some very oversold readings and that sort of stuff. So it might take a few weeks to try and find the bottom in here, but the probability is that there could be some relief rallies in the first quarter with seasonal rally for base metals. Once we're past the time of the bad season for crude oil, you could get a rally in crude, and the bad, often dismal lows for crude can be set in January. And this is just early into January. So let's allow some weeks for this kind of violence churning around, trying to set a bottom. But by this time, many of the offside accounts will have been sold out. But there's been such a change in the credit markets and in the stock market that somebody could be seriously offside. A fund or a broker or somebody who is offside. This has been a very serious change. So this is to answer the question about what was missing is announcements of insolvencies in serious places or even defaults. So that is still a probability over the next few weeks, and then one would then contemplate a first quarter being slightly better than, some recovery. But I think the probability of a a new bull market is way down the line. There's a lot of excesses in the financial markets, and they will have to be wrung out, and it's going to take some time. So I wouldn't be eager to get positioned in here, no matter how attractive they look. Actually, they would only look attractive on an oversold basis, and that's strictly for, I would say, very talented traders.
Bob, we do have an insolvency report. Bloomberg reporting that Canadian business insolvency was up 9% year to year in November.
Yeah, those are insolvencies. But what I'm thinking about is like in 2007, that's when we were looking for the credit markets to begin their change in that May or June. And indeed, in May, the yield curve reversed, and then in June, the spread started to widen. And that's when it was announced that Bear Stearns had an immense problem with a highly leveraged credit market fund they had. So that was distressful news. And then there were a few other more minor, but the stock market then did remain intact until that October, when then it rolled over and declined. And I remember that one. Middle of October was the high, and then it began to sell off, and also there were problems in the housing markets, and credit spreads were looking ugly. And then that's where the Harvard economist Greg Mankiw came out with his classic statement that nothing could go wrong because the Federal Reserve had a quote, and his quote, dream team of economists. And December was the high for the economy. So,
and then we had to bail out GM, we had to bail out Chrysler, Fiat, we had to bail out banks. Yeah, so right now it's not that bad at all.
No, so then that was at the end of 2007, and I might mention that the widening of credit spreads was a virtual double from June 2007 until December 2007, and the same time around now. So from June 2018 to December. But there's been no big noise. Yes, there's been headlines about how severe some stocks have gone down, but there's been nothing about any major sort of defaults and that sort of stuff, which is sort of built into the cake. I mean, they've got to be there. It's just that when does it shake out, and you don't know specifically. And then in 2008, the market rebounded up until May, and then you're looking at the S&P started to decline again, and then the really ugly stuff came in that, I think it was August, when Lehman Brothers was discovered to be way underwater, and then that was then Panicsville, and the Federal Reserve doing this, and the Treasury doing that, and everything else. So the decline has been dramatic, but there has not been any really dramatic individual big stories with it, and that seems probable that they will eventually appear. So, and you can't name the names, unless one's a wizard, corporate analyst and keeping track of all the balance sheets, which is not our job. Our effort is to try and identify major moves in the markets before they happen, and that's worked out kind of well. So,
Jerome Powell, the head of the U.S. Fed, says he would not resign if he was asked to by President Trump. What's your opinion on that?
last summer when Trump first criticized the Fed, I thought, no, not a good idea. He shouldn't mix it up with the central bank. And then later on, I thought, yeah, good idea, because lay the blame on the bank, on the central bank, because at some point the public will demand sound money and sound central banking, and one of the ways to get there is to criticize the intellectuals and academics and economists that have created this very reckless central banking on the arrogance that a committee can manage a national economy and when there is no such thing as a national economy. Imagine that Canada, with their long 4,000-mile border with the U.S. and all of the trade that goes north and south, try and define Canada as a national economy discrete from any other economy. Well, it's imaginary. It's not exact and not possible. So here they have this figment of imagination, a national economy that can be managed. Utterly, it's so foolish I can't believe it, but it's been around for so long that many otherwise intelligent people go along with it. So this is what I guess on my part, Jim, is that as this contraction continues, the public is going to say, look at you guys spent trillions of dollars trying to prevent bad things from happening, and here we are in a whole mess of bad things. Actually, Bad Things sounds like a title for a Stephen King short story or novel, don't you think?
Well, you mix in a St. Bernard and a Chrysler.
Cujo.
We'll have more with Bob Hoye if Stephen King doesn't get him first.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome back. We're speaking with Bob Hoye. Bob, the first of two listener questions we're going to look at today. Bob, I look forward to your podcast every week. I've been waiting for you to give a buy on gold stock. You said in prior podcasts that the time wasn't right yet and that you would let us know. Then today you let us know that you got positioned about 6 weeks ago. What's the deal?
Appropriate question. And one can't remember exactly what one said, but we had been looking for a bottom. And, of course, when doing a podcast, you can't go into all the details. But for our paid-up subscribers, the advice was in early October that one of our comfort index indicators, which is gold, or the gold stocks divided by gold price itself, had stabilized and was looking good. The other problem we had was that the silver gold ratio was not yet working the right way, but the advice was in early October or early November was to begin accumulating gold stocks on weakness. And it slid for about a week after that and then started to recover. So, but the point is that paid-up subscribers pay for the privilege of getting the more inside timing. And on a podcast like this, where one really likes to talk about the markets and the bigger pictures, you just sort of have to limit it to that so that there is a distinction between free advice and paid for advice. So to our questioner, sure, come on in, take a look at the website, and take a subscription.
Bob, generally when the markets look like they're going to take a downturn, is gold a good bet?
Well, gold itself can be, you've got to be a trader in that one. One should always have, as the saying goes, a little gold reserve of gold coins and whatnot. But I prefer the gold shares because in a positive move for gold, the gold shares will outperform, and they're tradable, and just much more prefer the gold shares to trying to trade silver or gold themselves. And we've seen over the last many years the people who specialize in gold and silver and who do follow the supply-demand side have been terribly embarrassed since 2011, where you had that fabulous bull market. The silver-gold ratio got hugely overbought, and we pointed out that it got up to 92. And the only other time it had been that high was at the fabulous high for gold and silver in January of 1980, which was a long time ago. So, yes, we look at gold shares as an investment or for trading, and we are probably entering a pretty good bull market for gold stocks, but one has to be very careful in getting positioned.
We'll have more with Bob Hoye and another listener question right after this.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, a question from John Law. In the past, you've mentioned how record extreme RSI readings, and what is an RSI?
That's called a relative strength index, but let's just call it momentum.
Okay, Bob, so in the past you mentioned how record extreme RSI, or momentum readings, indicated a secular peak in the oil market in 1980 and 2008, which was followed by a secular bear market. In 2018, the Dow reached a weekly RSI of 92. Is this 5 points higher than ever before in its 120-year history? Does this mean the stock market is now in a secular bear market?
That's a good question. On the oil move in 2008, we had the upside exhaustions on the daily, the weekly, and I remember writing, it must have been about the 1st of July, that if the month, with the daily and weekly in, it would be a cyclical bear market for crude. And if the monthly came in, it would be a secular bear, and the monthly did came in and went from 147 down to, what was it, 26 or 27 in 2016. Yeah, the question is a good one, because the RSI on the Dow into January 2018 did get up to 92. The one we were looking at the time was the New York Stock Exchange Composite Index, which is some 1,500 stocks. And the RSI on that one got up to, off of memory, 89. and we compared it to the NASDAQ composite at the peak of the dot-com bubble in March of 2000, and that one was only as high as 84. So yeah, it's a good question from John Law. And is it in a secular bear market? The stock market, that is. And it's probable. The financial speculation really replicated some of the great bubbles in history, the one to 1929, the one to 1873, and I think all the characteristics, or most of them, of a great bubble were accomplished. And then the transition to heavy liquidation in the fall of the year is also distinctive of what happens to great bubbles. So I think that it's likely a cyclical bear market, and it's possible. We'll just see how it goes over this coming year. The probability is a secular bear market for the stock market within a lengthy credit contraction where everybody goes crazy in a bubble and takes on debt like you wouldn't believe, and it's more than can be serviced, particularly in a slowing economy, so it gets to be a problem. And these long credit contractions have still seen the usual 3 to 4 year business cycle prevail, but one would say that the recoveries would be weak and the recessions would be nasty or, not good. But the 3 to 4 year business cycle continues, but it could go on for a number of business cycles, which is another way of saying secular, on the credit contraction side. It would be other feature would be weak real prices for industrial commodities, but a very good real price for gold. This is why we like the gold sectors, because in previous post-bubble contractions, the real price of gold has gone up, and it puts prosperity back into mining. The real price reflects that, hey, you're getting a good price for gold relative to the cost of mining. So you would have energy costs being low, you would have equipment costs being low, and then because of problems slowing down in the base metal mining, you then have equipment and operators, miners, available at lower wages. So the gold business gets very prosperous in a post-bubble contraction, and this is where we're favoring the gold stocks in going ahead.
Bob, thank you so much for being on the show.
Jim, it's good to be with you, and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. If you have questions for Bob or any of our other guests, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.